let's take a few minutes then to think about where the markets are right now, Mark. And you mentioned some of the dollar strength. This then, the dollar being bid, what do we make of this? Is this all to do with interest rate differentials and changing expectations in markets on that front? Or is this to do with geopolitics? Because we have that in the mix now.
I think it's a bit of both. Rather than geopolitics, I might phrase it as a little bit of risk aversion, but that risk aversion comes back to the idea that people don't know how this inflation story is going to play out. At the moment, we don't know what the central bank reaction function is going to be, and that's really the key issue for markets out there at the moment. So yes, I think this dollar story is more about yields, but we're not sure where to take it from here. Will central banks hold the dovish line or not? And that's why I think next week, actually it's not inflation data we'll be looking at, it's the growth data, because we know inflation's there, but can the economy cope with tightening or not? That's really the key issue now.
And I suppose, yeah, can the economy cope with tightening? Can stock markets cope with tightening, Mark? And it doesn't look like there's any issue from a rising yield environment when you look at what's going on in Asia, but there's other dynamics at play there to do with China, which we'll get to in a moment. But in terms of the Western equity markets, the Western European markets, the North American markets, do you see any stalling as a result of this higher yield environment that bond markets are pricing in?
I think we see a rotation. So I think overall some stocks can do well. We know this. We know that, financial stocks, for example, will like if we get a little bit of a higher yield environment, a bit of a steeper curve, that might kind of help there. And there are certainly other environments that other sectors that can do well in this environment. But I do think it's more of a problem for the US, and that's because the US stock market has been really reliant for its overall gains on those FANG stocks, those big tech stocks, and some of those might really suffer because some of the valuations there seem very stretched. They're based on a world of free money forevermore that might be changing a little bit at the margin. So I think rather than a real negative story for stocks, it's about a stock rotation story. Finally, value might really get its kind of time. Of course, we have heard that many times this year and it hasn't worked yet.
I was just going to say, I think I've had that conversation before, but I'm sure we'll continue to have it, Mark. Let me just dive into what's going on in China, and you give us your thoughts on the mood music, because yesterday we flagged that things did seem a little more positive in terms of risk appetite for China because of some of the news flow. Didi, of course, a key part of that. Just getting a red headline across the Bloomberg now around one of the real estate companies in China. China's Sunac says it is said to explore the sale of tourism assets, just underlining that there are plenty in the real estate space looking for sources of cash and re-evaluating those sources of cash right now. What do you make of China?
So I think that, that highlights that, as you say, this property story is ongoing and it will be ongoing. It's not suddenly solved. But there's a bit of a change of tone from policymakers that they're willing to provide a little bit more support, a little bit less pressure. This doesn't suddenly let them off the hook, but maybe we're kind of easing up a little bit in the short term. On top of that, we've had positive stories from the tech sector. We've had Singles Day. It wasn't necessarily the absolute blowout day, but of course, we've still got a record number for Alibaba. There were some great sales, JD.com as well. So I think that's provided some positive mood music. And some people are citing the fact that Xi Jinping has been confirmed as the leader forevermore. That means kind of continuity in China. I can't see how that's a surprise to absolutely anyone out there. But people are saying it's kind of adding to this story that now is the time to get excited about China and Hong Kong stocks again.
OK, it does look as if he is going to ask them for another term. That does seem to be analysis coming through from our colleagues in China. We're out of time, Mark. 3 minutes on the markets. Thank you very much. Remember, you can get up-to-date analysis and insight from Mark and the rest of the Markets Live team. Go to MLIV Go on your Bloomberg terminal.